Hi, welcome to the ratio analysis question and answers number 3. Okay, I've actually got 2 questions on this workbook, and with the help of Excel, I'll go through them. This first question, I'm only really going to be looking at profitability. Really, it's just consolidate what I covered in number 1 and 2, and then I'll develop it that bit further as we go through the series. Okay, well, I want to look at some profitability ratios based upon the income statement here. I'm going to pick on 3. I'll deal with them one at a time. The first one I'm going to deal with is actually looking at the gross profit margin. All right, now what I'm going to do is I'll just do it by manipulating this very, very basic income statement. Okay, so hopefully remember what we mean by gross profit. Okay, let's move that out of the way because the gross profit really only needs these 2 figures here, the revenue and the cost of goods sold. So the gross profit is equal to the revenue less the cost of goods sold. So how do we work that? What do we mean by gross profit margin? Well, hopefully from the previous videos, you will know that that is equal to the gross profit divided by the revenue. So our gross profit, which I'll place in here, is equal to the gross profit divided by the revenue. And we express that as a percentage. Job done. So for every $1 of sale, we have made a gross profit of 50 cents. But of course, we're looking, what we'd be interested in is our expenses. So what I want to do is look at what's called the operating expenses. These are the expenses in running the business, the day-to-day stuff. So I want these operating expenses. So that's going to be these 3 figures. The selling expenses, because that's involved in the day-to-day running of the business, plus our administration expenses, and we're going to add into that all the depreciation. Now, of course, in reality, there'll be a whole stack more of expenses than this. But if you look at company accounts, they're very clever in their final annual reports of being able to categorize them into various sections. Okay, well, that gives us an operating profit. Okay, operating profit. Okay, it's not net profit, remember, of equal to the 250 minus the 160. So our operating profit margin will be equal to the operating profit divided by the revenue that we've earned. So take the operating profit, divide that by the revenue and express that as a percentage. And you can see that it will drop. If that figure was higher than this figure, then you know you've got a problem. You haven't worked out. Okay. Well, what about the other expenses? So let's call that other expenses. They're sort of financial. So you may ask, we've dealt with this before, why are this not included in operating expenses? Well, you know, however much the business does, whether it sells more, sells less, whether it controls its costs, whether it employs more people, incurs more expenses, these are not the day-to-day expenses brought on by the business. The income tax expenses, the income of the business, depends on which country you're in as to what it's called, but for example, the UK, we call it corporation tax. All right, other countries more likely to just call it a simpler name than that, company tax. Anyway, what have we got then? What we now have is our net profit. So we just take the profit that's left, and we're left with 60,000. So our net profit margin, which I guess is probably the one that we would be most interested in, would be the net profit divided by our revenue, expressed, of course, as a percentage. And clearly the numbers go down each time. So, summarize. Are these good? Are they not? And I mentioned this before, it depends upon the nature of the business and the nature of the market they happen to be working in. If, for example, it's a highly competitive market, your margins might be a bit small. Also, it depends to some extent on the rate of turnover. With very high turnover, you probably can make a good profit on just selling loads at a very small margin. For example, large supermarkets, the likes of Walmart would almost definitely have a very small profit margin. And if you don't believe me, go check. Right? Their company accounts are available online. Okay, profitability. I'm now going to move on to examine liquidity ratios. Okay, so what we've got here is the idea of liquidity as opposed to profitability. Now, one of the questions I want to do is actually slightly mix the two up. But let's start with the most obvious liquidity, and that would be nearly all the textbooks start with this one, and that is to look at what's called the current ratio. Well, the current ratio will be current assets divided by current liabilities. Nice and straightforward. So what have we got? Okay, well, here's our current assets. So we do need the current assets. And we need the current liabilities. So highlight that, make sure that's clear to see. So what are the current assets? Well, it's all added up for us. How neat, how lovely. So there we go. Cash, accounts receivable, inventory. Typical category of them. Okay, now let me just format that into dollars. I don't think there's any need to have them in to the nearest cent. So we'll do exactly the same with the current liabilities. So what we've got is the current liabilities here. This question, this one here, isn't it? Okay, let's Make sure that that is clear to see. Right now, you know, on here, you can see that the working capital has been worked out as current assets less current liabilities. So that tells us we've got positive working capital. All right, but what it doesn't actually tell us is the ratio between this and this. Okay, let's make sure they're common format. But what we now do is we simply divide current assets divided by current liabilities, and we can see we have a figure of 4. Pretty, a very healthy figure indeed. It means we could cover our liabilities 4-fold. Okay. Right. Okay. Well, that's number 1 done. So positive. Yeah, very positive. But let's do what's called a quick ratio. Quick ratio. I'm not being quick, but we'll see what we mean by quick ratio. The idea of the quick ratio is to do exactly the same as we've just done, but not including the inventory. So, for want of a better term, let's call it liquid assets. And this may require a little bit of delving into the business a little bit more. How fast can we turn this stuff here into cash? Well, let's take the cash itself. That's the obvious one. And I'm going to take all of the accounts receivable. Now, in reality, some of your accounts receivable may not be ever received because people do naughty things like not pay you. Businesses going bankrupt, individuals who owe you money, doing a runner, whatever. Anyway, I'm going to take that as fairly liquid assets. So why not stock? Well, in the previous lessons, we mentioned the fact that businesses cannot survive without stock. Therefore, stock sort of is a semi-fixed item, semi-fixed asset of the business. You imagine going into a supermarket with nothing on the shelves. It ain't a supermarket, it's just a shell of a building. Okay, well, the rest of it's exactly the same. You've got the current liabilities, and we've already worked that out. So all we do is apply exactly the same down here. And now we've got a ratio of 2. It's always going to be less because you've taken the stock out of the current assets. This, again, very, very healthy. It means we can meet our immediate debts twice over, assuming, right, that those liquid assets, these 2 here, right, are easy to turn into cash. Well, cash is cash, right, which includes money in the bank, various certificates of deposit, all these type of things. In other words, you can pay with them. Okay, I mean, you can imagine businesses shouldn't be handling much cash, as it were, in terms of dollar notes, dollar bills, £1 notes, euros, and whatever. It'll all be done through electronic transfer. Okay, what I do want to look at is this idea of going into something slightly different. I want to look at a debt to equity ratio. So what I want to know, well, what's all the debt then? Okay, don't jump in that too quick. What's the debt? Well, where do we go on the balance sheet to look for that? Well, we look at the finance by, and that tells us that we've got some debt here, long-term debt. Okay, that'll do. That'll get us started. But is that all the debt? Is that the only 200,000? Well, no, it's not, because you've got here accounts receivable, accounts payable, I should say. This money you owe. Can't get around it. So that's another $60,000 we owe. Okay, so make sure all of my currencies are properly formatted. Again, if you don't mind, I would like to see that might be look better if it were to a nearest whole number. Okay. So my total debt seems to add up too. Now, it's always worth double checking that you haven't missed anything. Okay, now we haven't got much to look at in this question. Right. So there's my total debt. So again, put that in the right format. So what I want to now know is what's the equity. Well, the equity is here. It's these two figures here. The common stock or shares of the company. And highlight that. And the common stock was 300. And the retained earnings. Now, you may say, oh, retained earnings, where did that come from? Well, the retained earnings is part of the equity of the business, very much so. All right. Now, in a proper balance sheet situation, you will see all sorts of different categories in that. A lot of reserves, a lot of money. These are all earnings that the business has made, plus any investment put into the business by your stockholders buying stock into the business or shares into the business. Right, so now we've got two very important figures. Now, again, if I can just format that. So what I want to know is, just looking at those figures, we can see that the amount of money in the business, this is why I wanted to keep this separate and out of the way. We can see that the owners own 590 of this business. In terms of the total assets is worth, as we can see, well, if you work out the total assets, you can do that by just adding up those figures. But the point being is, we are put into the business 590,000, but outside organizations have a vested interest as well. They are a stakeholder in that their stake in the business adds up to 260,000. So how does that compare? Well, what we do is we now do a ratio, 260 divided by the. So if I can just, now I need to go that to two decimal places. So I can see that 0.44 of this, okay, is in the form of debt to equity ratio. The fact that the figure is less than 1 means that we've got a bigger stake as owners of the business than those who have helped finance the business. Okay. Well, we'll develop this theme, particularly on the liquidity, and this, I think this all needs developing much further to get a stronger understanding, because, shareholders want a little bit more than just debt to equity ratio. They want to know all sorts of things. So there's a lot more ratios, a lot more percentages to come. Okay. Anyway, happy study.